All right, we're live. So today we're gonna host a presentation by Joseph Bonneau. He's an educator and researcher specializing in cryptography, protocol design, security economics, and human factors in security. And he's also serving as an advisor to the Zcash Company. So I'll just hand it over to Joseph and let him go. And then I'll take, if y'all have any questions, feel free to throw them in the chat box on the side of the live stream, and I'll kind of filter through those at the end. So take it away.
Okay. Well, hi everybody. I guess I'm not sure if there's video of me or not waving, but I'm Joseph Bonneau. I'm a researcher at NYU. So I wanted to just present what was a workshop paper that I presented about a month ago at Financial Crypto. And it's a little bit of I guess I'd view this talk mostly as several thought experiments rather than necessarily a complete piece of research. But the thought experiment that kind of got me going down this road was, how switch to present mode. The thought experiment that got me going on this research was thinking how expensive it would be to take over a blockchain system to try to kill it off. So there's this idea that's been it's been proposed before in the literature called a Goldfinger attack, which a Goldfinger attack, it's named after the Bond villain who's in Goldfinger. And the plot of that movie was that this villain wanted to irradiate all of the US gold reserves in Fort Knox. And the motivation was to make his own holdings of gold more valuable by sort of destroying the competition. So with cryptocurrency, the idea of a Goldfinger attack is you have some attacker who's kind of externally motivated to just destroy or disrupt some cryptocurrency system. So it could be somebody who has a short position. They've taken a significant short position so they can profit a lot if the value of the cryptocurrency goes down. It could be they have kind of an explicit short position, or it could just be that they're very invested in a competing system. So for example, you might just be a very large Bitcoin Cash holder and think, if we could really disrupt the Bitcoin network, that would make my Bitcoin Cash more valuable. So if you're convinced that another currency's demise would be to your benefit, then you would be a Goldfinger attacker. So that's kind of been one framing of this attacker as a Goldfinger attack trying to destroy. I'll also sort of describe it later in the talk as somebody trying to do a takeover. So there's a few analogies. They're definitely not perfect to doing a hostile takeover of a corporation. Okay, so if you're just brainstorming, what are all the different ways that you could disrupt a cryptocurrency? There's really a lot, and you can go to town with movie plot threats and thinking about violence and using the military, kind of bombing the miners or taking over keynotes, things like that. But for this talk, I'll be limited to sort of more limited attackers. So specifically, I'll be talking about a non-state attacker, not going to use the military, not going to be violent, maybe willing to do a visible attack. Maybe it would be better if it was a discrete attack, but aiming to permanently disrupt currency, or at least sort of have a fork that was so serious it would kind of damage confidence in the system in the long term. So if you want to do a temporary attack, there are a lot of ways that we know to achieve that. Probably the simplest way, I think, if you want to sort of temporarily make a system unusable, is you can just flood the network with transactions, and if you're willing to pay higher transaction fees than the rest of the community, you can sort of block all progress, and that's an exercise that you can go through calculating how much that would cost. It's not exactly clear because we don't know what the full demand curve looks like. If you flood the network with 10 times higher transaction fees that are being paid today, there's some people who would react by increasing the transaction fees they're paying. And there's some other kind of more explicit ways to do this. This one was actually mentioned by some other researchers at Financial Crypto this year, but I thought it was pretty interesting, which is to set up a smart contract on another platform that will pay major rewards if you publish an empty block as a miner. So if you mine an empty block with no transactions, you get some big lump sum reward that's enforced by a smart contract. So that would be a way to make this kind of more visible, to say basically I'm paying the miners more to publish no transactions than they would get from transaction fees, and that's kind of a way to make the network temporarily unusable. But like I said, the main focus I want to get to is talking about permanent attacks. Although the numbers for you, that's kind of the very, very simple way of calculating it, which, like I said, is incomplete. If you just look to sort of match the full rate of transaction fees that are going right now, those are the numbers you're looking at. In reality, you'd probably have to go maybe an order of magnitude higher than that to really sort of block out competition. Okay, so let me talk about permanent attacks now, where your goal is to actually gain 51%. Of course, that 51% number is pretty approximate. In reality, you can do a lot more damage with, or you can do a lot of damage with probably shy of 51%. And if you have more, your fork will be sort of more efficient to do the attack, because you can do a deep fork more quickly and more convincingly. But I'll sort of go with 50% plus epsilon for the numbers that are going to be in this talk. So the question is, how can you obtain 51% capacity in a system? And when I say capacity, what that means specifically depends on the system. So proof of work capacity, if you're talking about a proof of work system, stake, if you're talking about a proof of stake system, etc. Okay, so I'd like to lay out 4 different ways that you can do this on two different axes here. So one is, are you adding new capacity to the system, or are you taking over existing capacity? And the other is, are you permanently obtaining control of that capacity, or are you just temporarily obtaining control of that capacity? So I'd argue that each of these 4 is a slightly different attack approach with slightly different characteristics. So to give kind of a name to each one, if you're permanently obtaining new capacity, I would call that building. So think about sort of building a large new farm, buying a lot of new equipment, becoming a very large player in the system. If you're adding new capacity to the system, but only temporarily, that would be renting capacity from somewhere else. So probably the most ready example for an ASIC, ASIC resistance proof of work system, you might be able to rent some capacity from some cloud computing platform like Amazon is the one people always think of. Okay, so those are ways you could add new capacity to the system, either by building out new capacity or by renting new capacity. And if you want to take over existing capacity, well, in the short term, you might be able to bribe the owner of that capacity to do your attack for you. And I'll walk through what that would look like. Or if you want to permanently control some existing capacity, then you have to buy out whoever has that capacity today. And if you're doing that on a large scale, that's when it starts to look like a hostile takeover. Okay, so kind of right off the bat, and I guess I can say at this point, I think the main value here is really just to compare different ways of doing consensus and see how they fare in terms of these different attack vectors, some of which aren't going to be possible for certain types of system. So if you have an ASIC resistant proof of work, which, well, until recently anyway, was the reality for Zcash, but certainly the Ethereum and a lot of other GPU mined systems, it looks like all of these attack vectors are possible. Whereas if you have an ASIC-based proof of work, so something like Bitcoin, then at least to a first approximation, you can't really rent more capacity. And the reason for that is that since Bitcoin ASICs can't really do anything else besides mine Bitcoin, a plausible assumption is that all Bitcoin ASICs in the world are currently mining Bitcoin. So there's no spare capacity that you can go and rent. Of course, you can go and rent general capacity. You could still go to Amazon and rent a bunch of CPU time to try to mine Bitcoin, but the numbers are sort of so far from being economical that I've ignored that possibility here. And of course, with proof of stake, it's not possible to add new capacity to the system. There's a fixed amount of capacity, which is just all of the coins in existence. So you can't think about renting your building in proof of stake. You've got to go after capacity that's already there. So just from this slide alone, it kind of looks like proof of stake has a nice win here, although we'll sort of circle back and see why maybe it's not so clear. Okay, so in the paper I wrote, there's a little bit more detail, but not a whole lot of detail. This is meant to be sort of an abstract calculation, kind of a back of the envelope calculation of how expensive it would actually be to do a rental attack. So how expensive would it be to rent enough capacity on Amazon to be a 51% attacker for some time on the Ethereum network? So it turns out this is the GPU that Amazon rents. It's not considered the best GPU for Ethereum or for Zcash or really for any of the other GPU mined currencies. It's really actually a GPU that's designed for doing machine learning calculations, but you can use it. So it's not a terrible way to mine. And if you just push the numbers through for Ethereum, and these numbers are about a month out of date now, but relatively recent, it looks like it costs a couple of $1 million an hour would be your Amazon bill if you wanted to be a 51% attacker against Ethereum. Now, there are a bunch of caveats to this number that I should say. Of course, it's meant to be sort of one, maybe two significant figures, not extremely accurate. The other big caveat is that Amazon, at least they don't publicly announce how much total capacity they have to rent. But when I've tried to estimate it by looking at what they publish in terms of their overall revenue, it's pretty clear that they don't actually have that many NVIDIA units for rent. So you couldn't do this attack just by renting from Amazon. You'd be sort of renting all the capacity they have and then quite a bit more. So it might be a little bit more complicated. You might have to also rent some from other cloud platforms and maybe do a little bit more work to actually get to 51%, just because of the limited capacity for rent and the fact that Ethereum is a pretty big system. But it's still an interesting data point, and for some smaller systems, certainly for Zcash, which is a smaller system overall than Ethereum, then it is much more would be much more practical to think about renting enough space on Amazon to attack. So it shouldn't be surprising that renting is a lot cheaper than building, but to walk through the numbers for building. And again, this is very, very approximate, but just looking at the acquisition costs for the hardware, so ignoring a lot of other building costs, obviously land, rack space, all of those kind of things, just looking at the hardware, taking a better GPU for mining Ethereum. If you wanted to get to the current network hash rate of Ethereum by just buying up a bunch of these units, you'd be looking at a couple of $1 billion. And again, this is pretty approximate, kind of in two directions. For one, you could get a big discount if you were buying that much hardware in bulk. It would be hard to actually buy that much hardware. You'd be sort of buying more than the annual capacity that Radeon puts out. But of course, you would sort of spread across a couple of different manufacturers, buy used, etc. And then in the other direction, of course, there's a lot more cost than just buying the hardware. But just as sort of a rough estimate, you get to a few $1 billion to buy enough hardware to be a 51% attacker against Ethereum. And if you walk through the same exercise for Bitcoin and just think about buying kind of a off-the-shelf Bitcoin miner, again, if you were really doing this at scale, you might buy something else. But just for the sake of a rough calculation, we can take kind of the best available off-the-shelf miner. You can walk through how many of these you would need to attack Bitcoin. And again, you end up somewhere in the couple of $1 billion. So it shouldn't be surprising to see that renting is much, much cheaper than building. But it's interesting to just see that there appears to be about a 3 orders of magnitude difference in the price here. I mean, I think the most important thing to ask for all of these numbers is really, do they make sense given the total market cap of the system? Do you think that a few $1 billion or a few $1 million to do this kind of short-term rental, do those numbers make you nervous that maybe somebody would actually get it together and organize an attack like this? I don't really. That basically comes down to a philosophical question of how much you think it's worth investing in security. Because obviously, if you want those numbers to go up, you have to start thinking about paying the miners more revenue. Those numbers ultimately are pretty proportional to how much revenue the miners are making. And just to keep in mind, the total market cap of Ethereum hovers somewhere between 80 billion and $100 billion. It's been much higher than that at its peak. So it's just interesting to ask if those numbers seem like enough protecting a system with that much value. So one other comment that I think is in order here, I said that, to a first approximation, you can't do a rental attack against Bitcoin because there isn't a big market or there aren't a lot of spare Bitcoin mining ASICs sitting around. It turns out I know that's not true in at least one way, which is that there are a lot of old ASICs that have been powered off because they're no longer economical to run. That is, like, they don't make up even their marginal cost of electricity. They don't make back in revenue anymore. So presumably they're just sitting around somewhere and they have very little value. So if you could get all of the old generation of Bitcoin hardware, and as an attacker, you'd be willing to run it at a loss in the short term, that might be a really interesting way to, in effect, rent mining capacity against Bitcoin. So that attack, I haven't even attempted to estimate how much that would cost. It's quite interesting because those old Bitcoin ASICs have very, very little value. And I don't really know even what state they're in, if they've been destroyed or not. But if they were sitting around, it would be an interesting attack to sort of keep around the old hardware as a way to attack. And in the short term, you don't really care if they're losing some money to run. Okay, so let's move on to talking about bribery and how you could pay existing miners or existing stakeholders in a proof of stake system to participate in an attack to sort of do your bidding for you. So this bribery stuff is actually something I've been thinking about for a couple of years. So we actually know a bunch of different ways that you can pull it off now. And I'll start sort of from the most simple and build up to the more interesting ways that you can do bribery. So the most obvious thing is you can just go to the miners, out of band, which means you actually find out who they are and call them up and offer them some payment under the table if they mine on if they help your attack out. So if you're trying to fork the network, if they mine on your fork instead of the main chain. Of course, that's a lot of work. You have to know who they are. They have to trust you. You have to trust them. So it's not a great strategy for mining. Another thing you can think about doing is basically using the existing infrastructure around for mining pools. And you could just sort of launch your own mining pool that would actually pay out a negative fee. So it would your mining pool would lose money, but it would sort of by definition be a better deal for all the miners participating than any of the other pools, because you'd be subsidizing this to try to make your attack happen. And you can think about doing this something like pay per share, so there's very low risk for the miner, taking all the risk on board for the attacker. But that would be a way to pay miners specifically to do work units that you're assigning to them that already exist, so miners understand very well, and you can do this anonymously and so on. There's also some ways to actually do it in band. So in Bitcoin, what you could do, you could have a transaction that was only valid on your fork of the network that you're attempting. So sort of the first block you mine on your fork, you move some money to a bunch of addresses that are going to be time locked. Basically, one tranche of reward for each of the next K blocks. You're basically setting up free money. So you'd publish, anybody can spend transactions. So, the miner would be able to take them in their own block. Time locked for each of the next K blocks, which is basically committing to some bribe money sitting around that would sort of only exist on your fork. You can see on the main chain, you've kind of kept that money for yourself. So this is kind of nice because it's sort of proving to miners that if they participate in your fork and it actually wins, they'll have a bunch of extra money. But of course, the miners in this mechanism, the miners are eating all of the risk that if your attack fails, they won't be left with anything. And you could actually do a quite similar thing by just posting really large transaction fees and using lock time. Another way to do basically the same thing. The most interesting way to do it that seems to sort of fix all problems is to use a smart contract. So there was a really cool paper at the Bitcoin workshop this year that walked through the mechanics and actually did a proof of concept of having an Ethereum contract that would pay miners, would pay Bitcoin miners only if they mined on a specific fork. So basically, this Ethereum smart contract has to verify that you found a block, that it sort of chains to a specific block that's on the fork, and then it will pay out some rewards in Ether. So the nice thing about this is that the bribery money is committed to. The miners know that they're going to get paid if they actually mine blocks on your fork. And also they'll get paid regardless of whether the attack succeeds or not, because they're getting paid in Ether. So a quite interesting way to do bribes. So like I said, in comparison, sort of most of these mechanisms have a few issues, but the smart contract mechanism, and if you are interested in the details, you can look up the paper by Patrick McCory and his co-authors. It seems really nice. Nobody has to trust each other. The bribes are guaranteed, and they're still valid even if the attack doesn't work out. So really, really clever way to make these bribes happen. So how much should you bribe the miners to get them to work on your fork rather than the main chain? Well, the simplest analysis is you just have to pay the miners more than they're making by default behavior mining on the main chain. Which means you just have to look at the amount of revenue the miners are getting, which hovers somewhere around $1 million an hour for Bitcoin and for Ethereum. So basically, if you're willing to pay out $1 million an hour in bribes, that should be enough to convince miners to work on your fork rather than the main chain, and you could introduce kind of a deep fork into the network that way. And notice that that's really, really low, even cheaper than rental attacks. The question, since as far as I know, no one's seriously tried to do this, at least not against a high-value cryptocurrency. Will miners actually take that bribe? Will they be willing to take that bribe and make more money, or will they be smart enough to realize, well, I can make more money in the short term by taking this bribe, but if it's going to damage the system in the long term and cause the exchange rate to go way down, it's not actually a good move. And I argued actually in a paper 2 years ago that this turns into a tragedy of the commons. And a tragedy of the commons is an economic situation where everybody is incentivized collectively to behave one way, but individual members can all make money by defecting. And the way that applies in this case, all the miners would be better off if nobody took the bribes, if they ignored the attacker trying to bribe. So if everybody just behaved, in the default manner by mining on the main chain, it would be better for all concerned. But the individual miners all know that they can anonymously make more money by accepting the bribes. And if they hope that nobody else accepts the bribes, then they both won't damage the system and they'll make more revenue in the short term. So it's an interesting question if the kind of social dynamics around miners would keep them from defecting and prevent this tragedy that comments from actually happening. Okay, so if you remember the roadmap, kind of the 4 quadrants, we're now in quadrant 4, looking at what it would take to do a buyout, which is to just pay the miners to sort of give you their capacity forever. So for a proof of work system, not super interesting. You'd basically want to look at what the net present value of all the Bitcoin mining hardware is, and if you could offer more money than that, well, then the miners would probably sell out. And of course, they might sell a little bit for a little bit less because they'd be lowering their risk tolerance and so on. But as sort of a rough figure, it would take some number of billions of dollars to sort of buy out all current Bitcoin miners. And it's interesting that the net present value is roughly equal to how much capital has been invested by Bitcoin miners. And I guess I don't have a slide for it, but in the paper, I walked through it and found it was kind of interesting to see that it appears the total amount of capital investment in Ethereum mining is about the same as for Bitcoin mining, even though the Ethereum network has a much lower market cap. So kind of an interesting finding, but I think it makes some sense because the Ethereum capital investment can be repurposed for the most part. You can sell GPUs. There's still an active market for them. Whereas, Bitcoin ASICs, as I mentioned earlier, are sort of bricks if Bitcoin goes away. Okay, so talking about proof of stake specifically, it's kind of interesting to ask what it would look like if you tried to just buy out a proof of stake system to buy 51% of the capacity in the network. So the most interesting part of this that I'll just jump to is to say that once you make a threat that's credible that you're going to buy out a proof of stake system, that can be enough to really impact the market and the amount that you have to pay. And there are a bunch of examples of this historically. One of the most interesting ones in the early 90s, pulled off by George Soros against the Bank of England, basically committed to continuing to buy pounds until its peg, the exchange rate mechanism, was given up. And this kind of caused the value of the currency to crash. And I think that something like $1 billion were made in a single day by this arbitrage that opened up. So interesting story to look at. In the case of a proof of stake system, the interesting scenario that I foresee possibly happening is what I call a race to the door. And the dynamics would look like this. The attacker makes a buyout threat and says, I'm going to buy stake in the system until I control 51%, and then I'm going to destroy the system. So the more credible that threat is, it's more likely that the system is going to fail. And the more likely it is that the system is going to fail means that more stakeholders will want to get out. And that means that the price is going to go down, which means the attack is more likely to succeed. Failure will grow more likely. And there's kind of the risk of getting into this vicious cycle where everybody wants to get out of the system because the last 49% of stakeholders who don't sell are going to be left with nothing, or they'll be left with sort of tokens in a valueless system. And the interesting thing, I should say, about this race to the door is, remember we talked about using a smart contract to do bribery. Well, you could also use a smart contract to do this buyout. So you could basically assuming the smart contract platform had a lot more value than the system you were trying to buy out, you could basically put up enough money in your smart contract, and the smart contract would do sort of the cross chain buyout, that people knew you were serious about the attack. In fact, they would know that you were committed to doing the attack no matter what. So smart contracts in general, I think, are a really interesting way to make what would otherwise be non-credible threats credible. And this is kind of a specific case of that. So I guess I'll just sort of leave you with this slide and then switch to taking questions. And I'll just say, like I said, my goal in writing this paper and giving this talk today was more to raise questions than to, give specific answers at you. I think, even just trying to compare proof of work to proof of stake, we don't really have formal modeling tools that quite capture all the dynamics of these different attacks. In particular, I talked about in the paper, and you can read for details, there's the whole question of can the community respond and counterattack if they notice that an attack is going on? So, for example, if someone notices that you're trying to do this building attack, if you're building a bunch of new capacity with malicious intent, well, they can also try to build more capacity to try to ward off your attack. Or similarly, if you're renting to try to attack a system, kind of defenders of the system can also try to rent a bunch to ward off the attack. And that's true for bribery and for buyouts too. There's kind of the possibility of defense, although it raises the question of sort of who would organize this. How would you be able to break another tragedy of the commons, basically, that it would be great if there was an organized defense, but there's really no mechanism, that at least no built-in mechanism for most of these systems. And I think it's also fair to say, one objection I've gotten to this research is, well, these kind of large scale within the system attacks where you try to obtain 51% and then do a bunch of forks to sort of ruin confidence in the system. Should we really be worried about these? Because, if a government, if a really powerful agency wants to disrupt your system, well, they can do, physical violent attacks if they need to, or, the simpler version of that is arrest people or pass laws. So maybe they're not interested in these kind of attacks. And for smaller players, it's not clear that they would do such an attack for economic reasons, because, the community can also get together and just agree on a hard fork to invalidate the attack, in which case the attacker might have spent a lot of money for nothing. But I still think that, it's a very interesting way to both to compare systems and also to sort of say, at a bare minimum, if your system is very, very cheap to attack, so you could sort of you could certainly pick a point at which, I hope you'd be nervous. If I told you it was only $50,000 to rent enough capacity to start forking Bitcoin, then that seems, low enough to be in the range that somebody might just do it for as a troll. And I think the question is, well, okay, so $50,000 an hour would really concern us. Is a few $1,000,000 an hour enough? How do we decide what enough really is? How do we basically decide how much revenue miners should get to make all of these attacks more difficult? Obviously, we don't want to pay the miners too much, because then that has to come from somewhere, either transaction fees or inflation. But if we don't pay the miners enough, a lot of these attacks start to seem sort of within reach. So I should stop talking there, and happy to take questions that people have.
Great, thanks. We're on I think YouTube has a minute lag, so want to give people a chance to add questions to the chat. And if not, maybe there aren't that many questions, maybe we could also follow up in a thread on the Zcash forum or something like that, if people want to throw in some questions after the thought, especially if people are not watching it live.
Sure.
So So there is a question about essentially what sort of threat is Bitmain to the Bitcoin network, in your opinion, given that they're a supporter of Bitcoin Cash?
That's a little bit of a political question.
Mm-hmm.
I guess I don't have the numbers at hand of what does Bitmain really have enough capacity to to permanently disrupt Bitcoin. Um, but I guess I feel like Bitmain, it seems to be the case that they aren't incentivized to try to disrupt Bitcoin. I mean, I think the current thinking is that, Bitcoin and Bitcoin Cash are worth more today than Bitcoin Cash would be if Bitcoin kind of went down in flames. Um, so maybe that's a little bit of a
Mm-hmm.
not confidence building answer, but um, I think if they were convinced that, if they could wipe Bitcoin off the map, that Bitcoin Cash would surge and would be worth sort of more than Bitcoin and Bitcoin Cash were separately, then I would be convinced. But um, in the short term, I feel like Bitcoin and Bitcoin Cash, their prices are correlated enough that it would be sort of risky to attack one and not the other.
Great. We have another question about an interesting one that I was also thinking about. Is there any advantage to combining proof of work and proof of stake systems to counteract these types of attacks?
Um, well, it's a good question because there's no obvious answer that I know of. I don't see any obvious benefit because it seems like the attacker can, sort of do both at once. I mean, they'd have to sort of be doing two different attack strategies at once, so it's a little bit more complicated for them. But it doesn't necessarily seem. I mean, if the attacker is trying to attack by bribery, well, they'd have to bribe some stakeholders and some, proof of work miners, but probably each would be bribed half as much as if it was only one of the systems. So it doesn't seem like an obvious win to me, besides making things more complicated. But those are the kind of questions that the analysis I've done is certainly so high level that it doesn't provide kind of an obvious answer. I think that the challenge is always to develop a model where we can have more precise answers to questions like that. That's not kind of so simple and stylized that it doesn't capture reality anymore. And I don't think we have that today.
Mm-hmm. Do you know of any other research around these types of attacks that people have done, or maybe studies on the history? I'm not really privy to any major attacks on blockchain networks thus far, but are there any interesting insights that you have used to reference, or maybe that are ongoing?
Um, yes. So there've been really only a couple of workshop papers that sort of talk about that I know of that talk about things like bribery and Goldfinger or takeover attacks. And the the I mean, I think the reason is that there are a lot more papers that try to model Bitcoin miner behavior in a closed model where basically the price of the value of one Bitcoin never changes. Um,
Mm-hmm.
so there's been much more, the work there is much more advanced, and that the models are very well developed, and you can read a 50-page paper with lots of proofs and theorems. But to make that possible, you have to make this very significant simplifying assumption that that the value of units in the system is kind of invariant. So once you relax that assumption, and once you say, well, depending on how attacks happen, exchange rates will change, and the value of currency will, in real terms, will change. Then all of a sudden, the system becomes so hard to model that we can't really say too much. Which is my paper on this is pretty high level. Um, it's not like a detailed mathematical model. And like I said, the reason is that once you start introducing the fact that the exchange rate can change,
Hmm.
well, it sort of seems like you're modeling kind of the whole universe at that point, because almost anything could potentially affect an exchange rate. So it becomes very, very difficult to, uh, I think academic researchers obviously have a tendency to work on problems that they can prove things about, that they can work in a more of a closed model. Um, and this is kind of such an open model that it hasn't attracted a lot of research.
Hmm. Is there, does this apply, this type of, these attacks apply also to kind of the other less used and researched proof of models, such as like proof of storage and other things like that?
Yeah, as far as I know, things might change a little bit, but I think certainly the dynamics of bribery and buyouts seem pretty consistent, kind of across whatever you're working. I think renting and building might change a little bit. But that was why I sort of phrased everything in terms of capacity
Yeah.
for proof of space, for proof of storage, even for kind of these proof of elapsed time or proof of trusted enclave type of things. It still seems like the basic dynamics would apply. But if
Hmm.
I'd be very interested to read if there's a specific reason why the dynamics really changed, then that would be could be a reason to consider alternatives.
How much do you think that kind of, if an attacker is considering attacking some network, the risk of the community noticing and just like forking away from that, how much do you think that affects people from like these attackers actually going about and like attempting to do something? Because we haven't really seen any big things happen quite yet. And I wonder if that's because it's relatively easy to detect these sorts of attacks, and the threat of losing all this money for nothing.
Yeah. Yeah, I think that's a great question. I think it probably depends a little bit on the system. So, in the case of Ethereum, well, there's already been one major hard fork over the DAO bug, which was kind of intended to preserve the value of the system. It wasn't uncontentious. There's still Ethereum Classic, but there's like some reason to believe that the Ethereum community would get together on another hard fork if you really, did some bribery attack and kind of caused major chaos on the network. For other systems, it kind of depends on the track record. I mean, Zcash is also, I think it's more plausible to believe that the reaction would be a hard fork. With Bitcoin, the community is much more fragmented and the political scene is a little bit less certain.
Mhm.
So I would have, with all of these, with any system, who knows? It depends is kind of the answer. But I would have probably less confidence that Bitcoin would organize and have everybody agree on a hard fork in reaction to an attack like this.
Mhm. Cool. Trying to sift through. There's a lot of like people asking about if like Zcash is gonna go ASIC resistant or not,
Yeah,
so
so
we're gonna skip over those.
I was
um,
I was going to say as a disclaimer, I was intending not to weigh in today on
yeah,
specific changes to Zcash.
yeah. There's a lot of discussion on the Zcash community, so everyone that's curious about anyone's opinion about that, whether the company or the foundation, that's all pretty much available. So y'all can keep track
Yeah.
of those things in the community.
Oh yeah, I've
But I don't.
been tracking it, but
Yeah.
um,
Um, I don't see any additional ones, and I kind of threw in all the questions that came to mind for me. So maybe if someone is interested in or like watches this later on and has a question that comes up, maybe YouTube comments aren't the best place, but I guess that could potentially be an okay place. But maybe the Zcash forum would be better.
Yeah, maybe we could
We
put a
could start
link.
a thread
Yeah,
about it. Um,
sounds great.
but thanks so much for the presentation, Joseph.
Absolutely.
And yeah, thanks everyone for watching. Maybe we'll
Yeah,
do some
thanks for
more of
having.
these types of presentations with other advisors or interesting people.
Yeah,
So
I'd love to come back.
thank
Okay, so long.
cool. Take care.